This content is for educational purposes only and is not financial advice. Any results shown are illustrative, not a promise or guarantee of similar outcomes, and individual results vary. Options trading involves high risk of loss.
Hello, in today's video we'll be taking a look at the Tuesday, August 4th, 2026 trading session for the CBOE SPX index. We'll be utilizing the day trading GPS SPX daily key levels V 3.0 indicator, as well as the day trading GPS ribbon V 3.0 indicator multi-reset edition that is for indexes, stocks, ETFs, futures, Forex, and any global market. So in today's session, we have our standard daily key levels option strategy play, which went for a entry cost of $1,350 per option contract to an exit of $6,780, so that's a gain of roughly just over 400%. And then our early session lotto option strategy, an entry of $185 per option going into an exit of $2,650 per option, which is a little bit over 1,330% gain on that. Okay, so some of you may already be familiar with these two indicators from watching our other videos on this channel. For those of you who are not already familiar with it, so these two indicators work together for trade entries and trade management. The SPX Daily Key Levels V 3.0 indicator gives you the SPX Daily Key Levels auto-updated each day at the first tick of the 9:30 a.m. open. That's the 9:30 a.m. Eastern New York open for the SPX CBOE index. Our day trading GPS ribbon indicator also features a reset for different markets as well as the SPX index. So on the SPX index, it features an optional reset for the 9:30 a.m. open. So what this reset does is it gets rid of the pollution from the previous close, in which you have typically with a standard moving average ribbon, you'll see as we go ahead and turn off the reset here. Normally with a standard ribbon, what happens is that, especially on something like an index where you have a significant gap up or gap down each day, you get this kind of polluted effect that happens from the gaps from the previous close, which don't give you really an accurate read as to what exactly is going on. So, for example, if there was a reversal right off the bat, you would not see a red ribbon until much, much later in the session because of all the hangover effect from the standard ribbon. So with this reset, you're able to see more clearly what's going on from the beginning. If the move is going to continue in that direction, then it will repopulate and show you clearly that the move is continuing to happen. However, in many cases, there are going to be reversals right off the bat. So if there is a reversal, you will see an all red ribbon right away, and then you'll be able to jump in on a reversal on those types of days. So the advantage of this ribbon is you can see it both ways. You can do it on a dual screen, left and right, on a single monitor, or have, if you have multiple monitors, you could have one with the filter on and one with the filter off on different monitors. The daily key levels indicator gives you daily the auto updated at 9:30 each session, the SPX bull bear key price level, which that's what KPL stands for. Then you'll have these R levels above and the S levels below. So there's 6 S levels below and 6 R levels above. Then we have our midpoints, and we also have our QL levels. The QL levels are used for tight stop losses on bullish and bearish trades off of main key levels, the main key levels being the bull bear key price level, the main R levels, and the main S levels. So QLs above, such as the case here, would be for bearish trades, tight stop loss. QL below is for tight stop losses on bullish trades. So as an example, we have here our 9:30 a.m. open here. As you can see here, right after the open, it does start closing above R1, which is one of our main key levels. And then we get sort of a sideways move here. And then here on the 9:40 a.m. candle, we're getting a clear indication of the upper bands of the ribbon starting to pull away from the base. And we still have a close above R1. So that's our bullish signal for an entry on R1 is first the candle close above R1, and then the confirmation for jumping in the entry is going to be the all green ribbon with the upper bands of the all green ribbon pulling away from the base of the ribbon. Our tight stop loss is going to be the QL below R1. If you prefer the standard stop loss, which is what we recommend, the standard stop loss is going to be the midpoint below the level that you're basing the trade on. Since this is an R1 based trade, then in this particular instance, it's going to be the first midpoint below R1. Now in today's session, we're going to take a look at two different option strikes. One is our standard key levels option strategy. The standard play is the option strike closest to the level that the trade is based off of. In our standard key levels option strategy, there are three different strikes that you could choose from. If you want to look at yesterday's session video as well, we went over this point as well, and also went over our early session lotto option strategy as well in that video. However, if you look in the description of this video, you'll see a link to a longer video which goes into more detail about the full standard daily key levels option strategy and how you pick the three different strikes for that particular strategy, one being the at the money strike closest to the level that the trade is based off of. And then there are two out of the money strikes, which are also based on key levels. We're not going to go into all of those details in this particular video, as we're trying to make a shorter video today. But you could certainly look at either yesterday's video, which we went into more details about those particular strikes and how you choose them, or you can simply look at the link in the description of this video to a much longer video, which also outlines the three different strikes and how those three different strikes work out as far as cost versus profit benefit. Okay, so in this case, 76.4308 is the level that main key level we're basing the trade off of. It's a bullish trade. So the closest strike to that is the 76.45 strike. You can use either 0 DTE options or 1 DTE options with this trading strategy because you're going to be entering and exiting your trades all in the same session. So it's just your preference as to whether you prefer 1 DTE or 0 DTE. 0 DTE is better for the early part of the session, whereas 1 DTE would be better for entries later on in the afternoon session. That, of course, is up to trader's choice through use and practice as to which one that you prefer, whether 0 DTE or 1 DTE. In today's video, as in most of our videos, we'll be taking a look at 0 DTE options. So in this particular case, on this entry on the 9:40 a.m. candle, the ask price $13.50, so that's $1,350 cost per option for that call option. Your tight stop loss or standard stop loss is level based to begin with. It's not a price of the option. It's not a percentage of the option. It is simply using the key levels of the indicator for your initial entry stop loss. When you're doing any adjustment to your stop loss later, once it hits a target and you prefer to do an adjustment rather than an exit, At that time, you would instead be changing your stop loss to a price-based stop loss because you'll be moving it, if you're going to do any adjustment, to break even or better. And of course, break even would be the price that you had the option executed at when you bought it. Okay, so entry $13.50. There are three different um, targets for either exit or adjustment, just depending on your time horizon, how long you'd like to stay in the trade, and what your overall goal is with the trade. So one is going to be a scalp only trade. A scalp only trade is a one level move in your favor. The one level move with this indicator is based on the level that you're basing the trade off of. So in this case, R1. So a one level move on a bullish trade from R1 is R2. So when your price of SPX hits the R2 level, that is your trigger to either exit the trade 100% on the scalp, or you can do an adjustment if you want to stay in the trade and see if you're going to get a further move. The adjustment you would make at that time is to at least move your stop loss to break even, which is the price you paid, in this case $13.50. At the time that it's hitting here on 10:04, the bid is 26.60. So as you can see here, that gives you quite a buffer between the cost, the original cost, and what it's at now. So if you're going to stay in the trade, you were at least going to move your stop loss to 13.50. Remember, your original stop loss was level based, not a price of the option, but when you're adjusting it, you were adjusting it to the executed price. Now you can add a profit buffer on top of that, generally at the beginning of a trade, to see if we're going to get a more of a trending day. You want to really just add somewhere between 10 to 15% as an initial profit buffer to give yourself some more room. A third option, besides either exiting 100% when it hits the scalp only one level move in your favor, or taking the second option, which is keeping all of your original position and adjusting your stop loss to break even or break even plus a profit buffer, is going to be doing a hybrid, which is going to be available to you if you are trading 3 or more contracts. So if you're trading 3 or more contracts, this third option is that you are exiting 60 to 90% of your original position, and then on the remaining runner position, you are adjusting your stop loss to break even or break even plus the profit buffer. So if you have 3 as an example, and you exit 2 of them once it hits this scalp level of R2 on this particular trade, you're collecting your profit on those 2 contracts. Then on the third contract, you are adjusting your stop loss to break even or break even plus a profit buffer. It's 60 to 90%, so it's basically the majority of your position. So that percentage is just going to be different just depending on how many contracts you're trading. If you're trading 10 contracts, then you could exit 6, 7, 8, or 9 of them. If you're trading 5, you could exit 3 of them. That would be 60%, or 4 of them would be 80%. If you're trading 4, exiting 3 of them would be 75%. So you get the general idea. Okay, then on any continuing trending move, which you're going to gauge by this ribbon, a continuing trending move in your favor, when it hits additional key levels, being either midpoint levels, main key levels, or if there happen to be any contextual levels, the pre-market high, pre-market low, yesterday's daily high, yesterday's daily low, or yesterday's daily close, that happen to be in the path. In this case, in this particular bullish trade, there are none in the path. But if there were some in the path after the initial target, then those would also be additional waypoints in addition to midpoints and main key levels as far as any further adjustment or consideration for exit on runners. Now, the other two targets are going to be for a regular day trade. A regular day trade has at least a minimum required target of a 1.5 level move in your favor or a 2-level minimum ideal move in your favor. So a 1.5 level move in your favor is going to be 1.5 levels from the level that the trade is based off of. So it's based off of R1. In this particular case, 1 level move scalp only R2, 1.5 level move mid R2, R3. So in this particular case, 1102 hits the mid R2, R3 level. Basically, it's the same idea as the scalp. You just basically have a different initial target. You have the same three options once it hits the 1.5 level move in your favor. Either you exit 100% of your contracts, or you are adjusting your stop loss to break even, or break even plus the 10 to 15% profit buffer, or the third, the hybrid, if you're trading 3 or more contracts, exiting 60 to 90%, and then on the remaining runners, moving your stop loss to break even, or break even plus the profit buffer. Going back to the scalp hit here, 2660 is the bid of the 1004, so that's a profit of $1,310 per contract. On the 1.5 level move at 11:02 a.m. candle close 4760, the bid, that's a profit of $3,410 per contract. Now, we also have the 2-level minimum ideal move. That's going to be the R3 level. It's called the 2-level minimum ideal move because in 75 to 80% or so of sessions in SPX in a normal year, in a normal volatility environment, you're generally going to see 2-level moves, 2-level extensions away from the bull bear key price level. And in general, 2-level moves from any key level are going to be typically the max, and that's why it's called the minimum ideal move. So that could be a move from, say, R1 to R3. It could be a move from S1 up to R2, S1 up to R1. It could be bull bear key price level to R2. It could be R2 to R4. It could be a bearish move of R2 down to the bull bear KPL, or a bearish move from the bull bear KPL down to S2. Generally a 2-level move in your favor from the starting point of the trade that the levels that the trade is based on is typically going to be the extent of most moves. Now that doesn't mean that you can't get extensions beyond that, and that's why we have the hybrid plan where you are adjusting your stop loss to break even on remaining runners after exiting 60 to 90%, because on any given day, we don't really know where the trend is going to end because of news and other events that are happening. So that hybrid keeps you in a trade in a de-risked runner after already collecting profit, and allows you to continue to ride momentum if the ribbon and price action continues in your favor. Because again, even though 75 to 80% of sessions generally have a 2-level extension away from the bull bear KPL, there are also the sessions and the remaining 20% that are the minority of sessions in a given year. However, those sessions can go all the way to R6 or S6. And on any given day, we don't really know what those sessions are going to turn out to be at the beginning of the session. So a lot of times they just occur. You'll get moves beyond R3 or below S3. They don't happen that often in a given year unless you're having sort of a COVID pandemic or market meltdown environment, typically where you have a lot of extreme volatility for long periods of time. However, in a normal year, you will get a series of those types of higher volatility extended range sessions that do happen now and then throughout the year. So that allows you to, that hybrid approach allows you to take advantage of those should that type of session end up occurring, and being able to stay within that trend that happens to be happening with de-risked runner positions, and then that gives you more control to calmly uh, manage that trade since you've already extracted profit out of the trade from the majority of your original position as price continues to move in your favor, and you can make a more objective decision about uh, if you want to exit some of your remaining runners, depending how many runners you have, and keep uh, managing your stop losses as price continues to move in your favor throughout the session. Okay, so here on this particular candle here, the 12:04 p.m. candles, where we finally got a hit of the R3 level finally within the intra candle here on the wick up. So we got very close here, very close here, very close here, but finally here, 12:04 p.m. The bid on the close of that candle was a little higher on the wick hit, but on the close of the candle, 67.80. So that's a profit of $5,430 per contract on this standard daily key levels option strategy. Standard play 76.45 call option being the closest to the level that we're basing the trade off of. As you can see here, we did get an extended move, and now we're currently at mid R3, R4. So again, as I stated earlier, regardless of which one of the original adjustment or adjustment exit targets you have, if you're trading multiple contracts and you can have remaining runners to stay in a move, once you de-risk them, then it makes it easier for you, depending on what you're seeing from the ribbon as far as continuing momentum, to stay in a trade, and then depending on how many remaining runner positions that you have, if you have multiple ones, then as it hits a continuing level in your favor, you can take off another one and exit another one, manage and adjust the stop loss on any remaining ones, and as it hits another one, take off and exit another one, and so on and so forth. And because you really don't know where exactly this is going to end at the before the end of the session. Okay, so now we're going to look at the early session lotto options play. Take a quick pause here. Okay, early session lotto option strategy. Basically, there are two different options strikes that you can utilize with this. We're going to look at one today. If you look at our video yesterday, we went over both of them. We're not going to do that again today. We're just going to look at the one. But just to explain to you what the difference is between this and the standard option strategy. So this is for the early part of the session. What you're looking for is you're looking at the option strike that's going to be at the 1.5 level move or the 2 level move in your favor as your entry strike. So you're still basing the trade on the same entry. You still have the same stop losses that you would have with the standard daily key levels option strategy that we looked at earlier. You're just changing the strikes. So you're taking the 1.5 level move target. In this case, it's mid R2, R3. That's 1.5 level moves away from R1. 76.90.10. So that's going to be the 76.90 strike. The furthest away would be the R3 because that's 2 levels away, so it's 77.13.60. So that would be the 77.15 strike. Now the entry and everything else is the same as far as managing the trade, your target levels for exit or adjustment. The only thing that's changing is the strikes based on the relationship on the key level chart from the level that the trade is based off of, in this case R1. 9:40 a.m. ask $1.85. So as you can see here, the previous one was that we looked at, the 76.45, was $13.50. That's $1,350 cost per option. This is only $1.85, so that's $185 cost per option. So you can look at it two different ways. Either you're just spending about $1,200 less because you're just buying one option, or you could buy, say, six or seven of these for about the same cost as the other one. And as you'll see here in a minute, how that can be magnified as far as the profit if you do get a extended move like we did today. On the other hand, the other way of looking at it is, on this case, if you're just buying one option, on the early session lotto option strategy, you're only putting $185 total at risk. So even if we got news, for example, and let's say there was some kind of Trump tweet or something that was a negative on the market, and all of a sudden we got a massive move down, and let's say it just blew through these stop levels instantaneously, which that does happen sometimes on these tweets, on very fast intra-candle moves that you get on these tweets, sometimes they can move against you quite suddenly, and there's really no way you can prepare for it. You still just have the same process, have your stops in, but that's something that no matter what you're trading in the current environment we're in, that we're just subject to those sort of things happening with the war going on, and the kind of things, moves that can happen intraday from just instantaneous news that happens to come out that can affect the market, either affecting your positions positively or negatively. Okay, so in this case, like I said, $185 total. You're still going to use the same tight stop loss or standard stop loss as the entry because it's based on the level that you're doing. Same process. If you're adjusting your stop loss, you're adjusting your stop loss to break even, the price you executed your entry at. Everything else is the same. You're just simply using different strikes, the 1.5 level move and the 2 level move, because those are the strikes for a regular day trade. However, on an early session lotto option strategy, those become the lotto option strikes. So the 76.90 is the 1.5 level move, $1.85 entry. Now, when we hit the R2 level here on this particular candle, 10:04 a.m., the bid is $4.10. So that is a $225 profit on that particular trade, but you have to keep in mind it's only a $225 profit. However, you only put up $185. 1.5 level move, 11:02 a.m., mid R2, R3. Now the bid is $11.70. That is going to be a profit of $985. Again, starting from $185. The 2 level move here, 12:04 p.m. Now the bid is $26.50. That's a profit of $2,465. So that's roughly a little bit over 1,300% gain from $1.85 to $26.50. Now, it has continued to make a move even further. So obviously, if you had any remaining runners that were de-risked earlier on, Obviously, these would be a lot more in profit now based on this continuing move up here past R3. So we've moved up another 25 points or so here to mid R3, R4. However, the early session lotto option strategy in general, you generally want to be out of these trades by around noonish time. You don't really want to be holding on to these after lunch. If you are going to be holding on to any, you definitely need to only be holding on to completely de-risked runners, and that would be after you've already taken off profit on the 60 to 90%. So if you're only trading one contract, or you're trading less than 3 contracts, you just definitely want to be out of these around noonish time and not be holding on to them later on in the afternoon. If you're trading 3 or more and you've already extracted profit and you have completely de-risked runners and you just want to manage the runners further on to see how far it goes, that's a whole nother story. And then you can simply decide when to get out later on in the session as you can continue to adjust your stop loss on any remaining runners as price continues to move in your favor. Again, gauging again by the ribbon, which in this case we're just getting moves down to this top moving average thick line here of the ribbon, and then we're getting a bounce off. So we're getting basically this classic stair step, stair step, stair step, stair step. And, you know, until this changes, it could continue to go up, and we could actually even see R4 later today. You just, as I said, you don't really know how far something is particularly going to go. You don't know what kind of news may come out still before the session ends. So when you're dealing with de-risked runners and you've already extracted profit, 60 to 90% of original position profit out at one of those 3 particular initial targets, either the scalp only 1 level move, the 1.5 level move, or the 2 level move, and then you're dealing with de-risked runners, then you're in a little better control and able to properly manage because you've already extracted profit, 60 to 90% of the original position, and then you're just simply managing de-risked runners. A little different game. If you're only trading one contract, then you just have to be satisfied with your exit on whatever particular exit that you chose, either the scalp, the 1.5 level move, or the 2 level move. You can obviously keep adjusting your stop loss and not exit. However, on one contract, there's not a whole bunch of room to do anything. You're basically confined to either adjusting your stop loss or exiting. So when you're trading 3 or more contracts, then you have a little more flexibility. Some people that is why some people prefer to trade the mini SPX index, the XSP. This indicator also works on the XSP for those particular people that prefer that. One reason why people prefer the mini SPX index, the XSP, is because of the fact it trades at 1/10 the value of the regular SPX index. And so if you have the money to normally trade with, say, one regular SPX option, you can trade 10 XSP options, as an example, with the same amount of money, generally speaking. So, you know, for those that only really have the money to trade one SPX contract at a time, that's really just your own call as to whether XSP works better for you than just trading one, and whether you prefer having the flexibility of having, say, 10 lots instead of just a 1 lot. So that's up for each trader to decide for themselves. Many people prefer trading XSP even over SPY because of how SPX options in general are treated versus SPY. I'm not going to go into that today. You can simply either Google that, advantages of SPX and XSP options over SPY, or you can ask ChatGPT or Claude about it, and it will go into the differences, especially between XSP and SPY, and why you may want to consider trading that versus SPY options. Okay, so that is going to do it for today's video. If you are interested in purchasing either the SPX Daily Key Levels Indicator or our SPX Indicator Suite, which includes the ribbon indicator, as well as one additional indicator, which we're not going to go into today, but the SPX Suite includes 3 indicators, or if you just want to get the SPX Daily Key Levels Indicator by itself, you can email us at daytradinggps@gmail.com to request a discount promo code for either the SPX Daily Key Levels Indicator or the SPX Suite, and we will send you a promo code for a substantial discount on your purchase. We'd like to close out the video now by showing you some reviews and feedback we've received from traders who utilize our daily key levels indicators and our daily key levels trading strategy. You may be wondering, how this is working for people that are using it in live trading on a daily basis, how this is working out for other traders who are actually utilizing the indicator in the daily key levels trading strategy. So we'd like to show you those screenshots of feedback and reviews we've received. You can see all the reviews and all the feedback on our WAP.com site. Just simply go to www.wapwap.com/daytradinggps. Click on the reviews there and you can read them all for yourself. We're just going to show you those now to close out the video. We thank you for taking the time for watching today's video. If you did like the video, please hit the like button, as that helps us with the YouTube algorithm, so we'd appreciate that. And we wish you much prosperity in all your future trading.
For those interested in seeing how other traders are using the indicators and the daily key levels trading framework, here are some reviews and feedback we have received from customers who have purchased and used the indicators. While individual results will always vary based on experience, risk management, and execution, these reviews provide insight into how traders are incorporating the daily key levels indicators into their own trading processes. You can view additional customer reviews and feedback at daytradinggps.com. Thank you.